And this is joint work with Johannes Stroebel and Maximilian Fuchs. My name is Julian Terstegge, and Max and I, we are both in our final year as PhD students at Copenhagen Business School. All right, some background. A key global policy objective is the reduction of carbon emissions. And a common policy tool to get there are cap and trade systems, which today cover about 18% of global carbon emissions. And under such cap and trade systems, regulators issue a limited number of emission permits, and then they allocate them somehow. Mostly they sell them to firms. And once firms have these permits, they can trade them among each other, such that we get a price of an emission allowance. And this equilibrium price is driven by the interaction of permit supply, which is mostly regulation and climate policy, and permit demand, which is economic output and abatement costs. Right? How many permits we need depends on how much energy we consume, and the abatement costs describe how much it would cost you to avoid having that emission. So that also enters. And since future permit supply and future permit demand are uncertain, the future carbon price is uncertain. And throughout, I'm going to use the term carbon price to refer to the price of these emission permits. And this uncertainty in the carbon price is potentially important. There is a long literature arguing that uncertainty can delay irreversible investment decisions. That goes back at least to Bernanke in the 80s.
So and may I ask a question?
Please.
So can you go back to the previous slides? Like regulators actually issue a limited number of emission permits, right? So what is the main determinant? I just wanted to know, like, what is the motivation? Like, is there any optimal number of permit that they should issue? And they also know that this will affect, demand, like, demand, right? Like it affects the price.
Right.
So do you think that regulators, like, in anticipation of the price later on, they could issue, a certain number of permits, right? And then knowing exactly how the number of permits will actually influence the price later on, how will this translate into the uncertainty that you are actually, trying to measure here? Yeah.
Right. So I'm going to focus on the EU cap and trade system, where this is very regulated. They set up an initial amount of emission permits in 2013, and then it kind of stepwise reduced it. So they didn't make that many changes to it year to year. But I'm going to go into those details when I get into measuring that thing. The question, what's the optimal amount of permits for an economy? I think that's a very interesting economic question. That would be a great paper to answer. It's just we don't address it here.
Okay, thank you.
All right, so the theory part, if I apply the arguments to an emission trading system, it would go something like this. That polluters have the real option to execute one of those decarbonization investment projects. And if carbon price uncertainty goes up, then the value of waiting to exercise that option goes up. And so then for some projects in this economy, the NPV of waiting might exceed the NPV of exercising that real option. And so then in total, you might see a negative effect of carbon price uncertainty shocks on decarbonization investments in this economy. In addition to this theoretical prediction, if you start reading on this, carbon price volatility and uncertainty is actually quite a heavily discussed topic in this area. I have just two anecdotes here for illustration. The first one is from a report that the Green Party in the European Parliament commissioned. And they just state that the extremely high volatility of carbon prices in the EU ETS, coupled with the vast excess of carbon allowances, entirely explain its failure to meaningfully contribute to climate change mitigation. And then to see the other side of this argument, we take here something from the annual report of a large German energy provider. And they say a carbon price floor would reduce volatility and uncertainty for any investor, which makes offshore wind projects without revenue stabilizing mechanisms more viable and thus increases the speed of the urgently needed transformation to low carbon energy systems. And so in this paper, we address the question, does carbon price uncertainty inhibit investment? And is this effect quantitatively important? To answer these questions, we first of all measure carbon price uncertainty with this measure that we call the carbon VIX, that we derive from options prices in the EU emission trading system, and that we make available on this new website here. Then we document the properties of carbon price uncertainty, and finally, we test the real effects. What we find is that carbon price uncertainty is high. I'll show you an average carbon VIX of over 50%. If you compare that, for example, with the US equity VIX, that sits at about 16% and reaches 50 really only during times of severe market stress.
So one quick question. So related to uncertainty, right? So the way I view uncertainty is more about like, the distribution, right, of carbon prices, right? Like then like when you use VIX, that's really interesting. The question is whether there are other like alternative measures or, on top of VIX that you could use, right? If you think about the whole distribution, so to assume that the prices like the returns are normally distributed, then I would assume, right, that VIX could be like the appropriate measure of uncertainty. Now, also that you can back up this skewness measure here from option prices. You can back up also the fourth moment. Then the question is, whether like VIX alone, is the main determinant of uncertainty. Like, can you, is it possible to add to your measure like, skewness that you compute from option prices here, from these prices here, and also the fourth moment, and maybe come up with a measure. I'm not saying a weighted measure, but come up with a measure that actually characterizes uncertainty that actually is embedded in the distribution, not just VIX. I know that VIX is important because VIX is the main contributor of uncertainty, but sometimes other measures also are really important. Yeah.
So traditionally, the uncertainty literature has focused on the second moment, and that's what the theories are linked to. So that's what we measure here. I totally agree that these options, these carbon options, can be used to measure higher moments in carbon prices. And we are thinking about that. And I totally agree that the tails of that distribution are interesting, potentially relevant, just that they don't answer this question directly, and we do not focus on them in this paper. All right, so carbon price uncertainty varies over time. I'm going to show you that. I'm going to show you persistent shocks. The timing is going to be insightful. And I'm going to show you that carbon price uncertainty is distinct from other uncertainty measures. And then finally, we get to the real effects part, that carbon price uncertainty substantially reduces decarbonization investments. All right, the first part of the paper is about measuring carbon price uncertainty. We measure carbon price uncertainty in the EU emission trading system. There are currently 27 cap and trade systems in the world, covering about 18% of global CO2 equivalent emissions. It's always this CO2e for equivalent because people translate the emissions in other gases into what this would mean in terms of CO2. The EU ETS is the world's oldest. It exists since 2005, though we focus on its latest phase. So our sample is going to start in 2013. And it's the largest cap and trade system in the world by means of covered emissions. The EU ETS covers scope 1 emissions, so like your direct emissions from, for example, burning coal. So it does not cover these indirect emissions from, for example, the energy that you buy. And it covers more than 10,000 installations in the energy, manufacturing, and aviation sector in Europe. And one firm can have several installations, covering about 40% of EU carbon emissions. And during this third phase, regarding your earlier question about the amount of emission allowances in the system, in 2013, they set this at 2.1 billion emission allowances, or EUAs, where one emission allowance permits you to emit 1 ton of CO2 equivalent gas. So in 2013, the whole of the covered installations in Europe could emit 2.1 billion tons of CO2 equivalent gas. And since then, they have reduced this amount by between 2 to 4% per year. That's usually how these cap and trade systems work. You set some amount of allowances, and then you tell the market, we're going to reduce this over time, so they know they'll have to reduce emissions because there won't be that many allowances anymore. So firms have to report to the EU how many covered emissions they have, and then depending on what they report, that's going to be checked. They have to buy emission allowances, and then they have to surrender them once a year. It used to be in April over our sample. Now they changed it to September. And if you fail to surrender the sufficient number of allowances, there are heavy fines associated with that. So we observe a compliance rate above 99%. So firms actually do follow this market very closely. And EUAs can be rolled over. So you can buy them now and you can use them in 5 years if you want to. So the markets part. The primary market is mostly auctions. Governments auction off these emission allowances daily at pre-specified times to any authorized market participant. And then there's a secondary market where firms can trade these permits among each other. And then there's a futures market written on the secondary allowance market where most of the liquidity sits. And then, important for our paper, there are options written on those futures that we need for our uncertainty indices.
Just a quick clarifying question on the previous slide. So all of this works, how does it work exactly for foreign companies doing business in the EU? You know, this beautiful compliance rate, is it for everybody who does business in the EU? Does it pertain only to the pollution you do in the EU, and so on and so forth?
Right, so there's a border adjustment mechanism where they tax your imported goods depending on the amount of allowances, but I'm actually not sure how exactly that works. I'll have to look that up. I'm sorry.
Okay, and if I'm a US firm doing some business in the EU, am I subject to these fines?
If you have an installation, so a plant in Europe, then yes, you don't have to have your headquarters in Europe. But if you just sell your goods, then it would be this border adjustment mechanism that I'm not sure about.
Okay, thank you.
All right, thanks. Right, so these futures and these options are traded on the Intercontinental Exchange on ICE in London. And these futures are written on the EU allowances. They can be listed for a variety of expiration dates, but really they're mostly listed for the quarterly dates. So you get futures that expire in March and June, September and December. And one futures contract is written on one lot, so 1,000 EUAs. So they are quite large, and one futures contract is quite a large contract. The options, similarly, they can be listed for a range of expiry dates, but mostly they're just listed as quarterly options on the same March cycle as the futures contracts. They are European options, so they can be exercised only at expiry, and they have strike prices every 50 cents, which you're going to see next that at least recently, this gives us quite a fine grid of strike prices. Because here I show you the carbon price, the price for these emission allowances over our sample. It starts off quite low at about 5 euros per emission allowance per ton of CO2 equivalent, where there was just an excess of emission allowances in the system. So prices were very depressed and likely did not have much of an economic impact. And then around 2018, prices started to go up to about 80 euros per ton. And I think since then they've gone down a bit. They sit around 60 now. But now after 2018, prices are meaningfully higher. And so it's a lot more likely that this emission trading system has real effects now, that these prices have some bite now. And we do exploit these two different phases of the ETS in the paper. There's one phase where probably there are no real effects, and one phase where prices are quite high.
So did you just say, a quick question, did you adjust for inflation? Like, I'm just trying to figure out, like, if inflation, if you control for inflation, are you going to get the same graph?
I mean, inflation is not that high. It won't make that big of a difference.
Okay.
But this is not adjusted. No, this is purely just the price of an emission allowance.
Okay.
All right. And with the increase in carbon prices, you see that also the option volumes went up, even though they are quite high over the whole sample. On the left-hand side in these blue bars, I show you the average open interest of these EUA options in terms of underlying emission allowances. You see here in 2014, these EUA options in total were outstanding on about 0.2 billion EUAs, and towards the end of the sample, it's more about 0.4 billion EUAs. And volumes behave very similarly. Here on the right-hand side, the red bars show you the sum of volume over that year, which is at about 0.6 billion EUAs, and towards the end, it's more like 2 billion EUAs.
So just a quick question, like in 2018, you have a spike compared to years before 2018, and you also have a spike in 2021. Do you think that like there are some, there are some regulations or something happened in the market? I don't know this market well, so that actually, changes the price. Yeah. So if yes, what?
I mean, they do line up nicely with these spikes in price, right? When the prices go up, the option volumes go up. Whether that is due to speculation or because the market became economically more important and now there are more hedging needs, I'm not sure. It's definitely an interesting question, who is buying these options for which purpose? But in this project, we just say, thank you for the option, and we'll exploit their information content. In future work, we can definitely look into how much are they used for hedging by firms and why. And maybe that relates to your tail risk question earlier.
Yeah, and also if you look at in terms of regulations, do you think that something happened like during those, like in 2018, I don't know, 2021?
Yeah,
maybe yeah, go ahead.
I'd have to think about it, what happened, but I'll have to go on, otherwise I don't make my 50 minutes. All right, because now I want to show you that this volume is quite broadly distributed across strike prices and across expiry dates, which is important for our uncertainty measures. Here I show you for calls and puts separately. I sort them by moneyness, where I measure moneyness as futures price over the strike price of the option. And then I also separate them by days to expiry. And you see here that for call options, 37% of the total volume sits in these options that I say are deep out of the money. And the same thing for put options. The volume really is out of the money, which is what we're used to from equity index options, for example. If you look at the days to expiry, you see here that at the short end, the volume is relatively low, and most of the volume sits at the longer end of the maturities. which is different from, for example, equity options, where we see most volume at these short expiries. So since we have volume across a broad range of moneyness, we can implement this VIX idea that the CBOE, the CBO, introduced in the 90s. The idea of the VIX, right, is to construct a portfolio of options using out-of-the-money puts and calls such that the payoff of this portfolio at expiry of these options is approximately equal to the realized volatility of the underlying between portfolio formation and expiry. And so then if the expected volatility over that period goes up, then the portfolio price should go up, which just means that the VIX goes up. And so we follow the interpolation methodology for the standard VIX. We construct the carbon VIX for short maturity options and for longer maturity options. And then we linearly interpolate between those two measures. And we interpolate to 120 days, although we do show in the paper that this is not a consequential decision. This doesn't really matter. We just choose 120 days to maximize the liquidity in the options that we exploit. The advantage of the VIX is that it's model-free, right? It's just the price of a portfolio. The disadvantage is that you actually do need liquidity for a broad range of moneyness over your sample. And so we provide an alternative measure, the carbon implied volatility index, where we only use at-the-money options, their implied volatilities. I'm going to explain how we do it in detail. The downside is if you want an implied volatility, right, you need a pricing model to get it. But those two upsides and downsides are really nicely complementary, and we show that our results go through with either measure. And that's it. That is the carbon VIX over our sample. Show you here that at the start, it's quite high. It's at a level about 70 as this new market is established. And then as the market is established, uncertainty is resolved right until late 2015, when, if you remember, maybe that's when the Paris Climate Agreement happened. That's when many countries made strong commitments to reduce their carbon emissions, but they didn't make strong commitments on how they're going to do it. So that created quite a lot of uncertainty in this market until early 2017, when we observe a vote on how some of these countries are going to implement the promises from Paris, and that reduces some of the uncertainty in the market. Even though you see that the changes are quite slow moving, quite persistent. In 2018, the EU actually noticed that these prices are quite volatile, and so they established a market stability reserve, where if prices seem too high, they issue more emission allowances, and if prices seem too low, they issue less. Surprisingly, this really just created an uncertainty spike that then slowly resolved, but it didn't permanently lower uncertainty. And so those first four spikes here really are about the supply, or at least those three spikes here really are about the supply of emission allowances, right? They are about the about climate policy. And our last three spikes here are more associated with a demand for emission allowances, with a general state of the economy. Here, the COVID crash, the war in Ukraine, and the energy crisis afterwards. So that really highlights that both factors matter, not just for prices, but also for uncertainty, the supply side part and the demand side part.
So just one quick question. So if you have several countries in Europe, right? If in each country you use the index, right? You have options on the index. If you try to compute something more like the VIX, right? In each country, and you look at the correlation and you plot the graphs, I just want to know, like, sometimes when you look at COVID here, you have the spike, right? If you have any other measures, right, VIX, not coming from, the carbon prices, you also have spikes. So the question is, how much of this is really due to like carbon prices versus something else? So right?
So in all
You're
our
not mute.
regressions, we're going to control for the equity VIX to make sure this is actually about carbon price uncertainty. Here, I actually don't care that much whether this also happens in other measures, right? This measure shows me expected uncertainty in carbon prices. And I really like that there's also just general economic uncertainty in that. So that's why I don't show you the residuals here. I just want to know what happens to the carbon VIX itself. Okay, so our first two main findings. I just plot the carbon VIX next to two related measures. Here in red, the European equity VIX in these dashed lines, and then the oil VIX in these blue dotted lines. And the first thing is you see that the carbon VIX is very high related to both measures. And the second thing is you see that the carbon VIX varies substantially over time, and I already showed you that it spikes around climate events. The third thing is that the carbon VIX is distinct from other uncertainty measures. Here I just show you correlations, show you the correlation of carbon VIX changes with carbon price returns, which is negative at about 30% at the weekly frequency, as we're used to, that prices and uncertainty are negatively correlated. And then here I show you the correlation between carbon VIX change and equity VIX change at a moderate 10, and the oil VIX change at a moderate 14. So the point here is that conceptually, carbon price uncertainty is a distinct measure from related option-based uncertainty measures. And then just for completion, I show you here in this red dash dotted line, the realized volatility of carbon allowances. So you see that the carbon VIX and the realized volatility spike at similar times and behave very similarly. So the carbon VIX definitely captures real information about this market. But also you see that the carbon VIX is generally higher than realized volatility, right? So there seems to be a volatility risk premium in these options. Right. And then to our alternative measure, the implied volatilities. Here I just show you the implied volatilities again for puts and calls across my portfolios. And what we do is we take the put call pair that's just above the strike, above the price of the underlying, and the put call pair that is just below. And we take the average of those four implied volatilities. And we do the same again for options above 120 days. And then we linearly interpolate. And that's why we don't need that many liquid options for this measure. And here I just show you that really quickly. The carbon VIX in the solid blue line and carbon implied volatility in the dashed red line. You see that those two move very closely together. That's also why it doesn't really matter which one we choose for our real effects regressions. And on the right-hand side, I show you the carbon implied volatility for two different horizons, for 120 days and 360 days. And you see that the horizon that we use for the uncertainty measure also doesn't have much of an impact. And we don't do the carbon VIX at 360 days because eventually, if you go out far enough, the options do become illiquid in the tails. So doing 360 days, we're really only comfortable doing with the implied volatility measure. That's how we study the term structure. All right, so now that we've looked at what carbon price uncertainty is, we'll get into the real effects part. And the first thing we do is we look at CDP survey reported investments. The CDP is the Carbon Disclosure Project, and every year they provide about 10,000 firm level responses to their survey. And unfortunately, these surveys are voluntary and they are not verified, the answers of these firms. And the firms report their emissions amount and they report their emission targets. And those data have been used quite a lot recently. What has been used much less is data on abatement projects. which means these firms write down what actually they do to reduce their emission amounts. Specifically, they tell us the activity type, the amount invested, and they give a textual description of what they do to reduce emissions. And we're going to exploit all these parts in our paper. And we're going to focus on the sample after 2015, because after 2015, they tell us the scope of targeted emissions. They're going to tell us whether they did this project to reduce scope 1 emissions or scope 2 emissions or scope 3 emissions. And we really want to focus on scope 1 emissions, and that's why we only look at 2015 onwards, which leaves us with a sample of 2,800 firms of about 12,000 projects. And here I'm going to show you 2 slides with just summary stats to give you an idea of what is in these data. Here sorted by country. From the US, we see about 260 billion in total decarbonization investments over our 7 years of that sample. We get them from about 400 firms, where half of them report projects. And you see that the reported investment amounts are quite heavily skewed. For the US here, you see that the average firm reports, or the average reported investment amount is 130 million, but the median is 370,000. So there are many small projects and some very large projects. And you see this across countries. Besides,
just one clarification, like your carbon prices are from EU, right? European like countries, right? Then why focusing here like on several countries? Like, what is the main motivation showing us like other countries? Like, I thought that like at the first glance you would just present like US, like European countries. Now I'm seeing like countries all over the world. There's an explanation. Yeah.
No, you're totally right. That in our regressions in a minute, I'm going to focus on firms in the EU. This is just to show you what is in the data and what you could do with them. And I am actually going to use information from the US when I just generally want to know what do firms do to decarbonize. But you're right that in the next step, I'm going to focus on European firms, and I'm going to make that clear when I do it. Right, so we have a bunch of countries, most of them from Europe. US and China are in here. If we have a short look across the industries that are covered, you see that the vast amount of decarbonization investments are from the utility and power sector, about 440 billion over our sample. The next largest is the manufacturing sector. Maybe noteworthy that we have way more manufacturing firms than we have utility firms, but at the same time, in total, they report much fewer decarbonization investments. So this is just to highlight that this is quite a rich data set if you want to study firms' decarbonizations, and we only exploit a small part of it. I can skip that one and just get to the part that you alluded to, where I want to subset to European firms. Okay, we want to know whether firms' reported decarbonization investments are in some way related to carbon price uncertainty. And to find that out, we run this regression. We regress for a firm over their reporting period, their decarbonization investment ratio on these things, where decarbonization investment ratio is the decarbonization investment that they report divided by their scope 1 emissions that they report. Exposure is an indicator that tells me whether that firm is covered by the emission trading system. So not all European firms are covered by the ETS, and so we have some nice variation that covered firms should be impacted by carbon VIX and non-covered firms should not be impacted. And then I interact my exposure measure with the level of the carbon VIX over the reporting period. And as I said, I only do it for European firms because they are a good comparison for the firms that are covered. And then I have controls like firm characteristics, I have firm fixed effects, I have time fixed effects. I'm going to run this regression over the high price sample after 2018, because that's when I actually expect real effects. And this is the result. Maybe first, yes,
If I can.
please.
Just so this regression is going to be run only on European countries, correct?
Yes.
Okay, and so I'm making a link between the previous question and the question in the chat. So I gather that in these European countries, the way this is going to be monitored, the decarbonization investments, is going to be pretty homogeneous, right?
Yes, I think so.
Okay. But then if we did go out of that sample, it could be much more heterogeneous.
So, I mean, in the EU ETS, it is monitored, right? Because it's a regulated system, but these survey responses are not monitored anywhere. So they can tell us pretty much whatever. And that's why we go on to use a different measure later to address that downside.
And just a last question about the sample. So will you today show us any result using firms outside the EU or not at all?
No, today I'm not gonna work on that at all.
Okay, thank you.
And the standard errors are clustered by, given that carbon VIX is the same for all of those firms.
The standard errors are clustered at the, actually not sure.
Yeah, so sort of my question is, because VIX here is like 6 months or even 12 months, and the reporting period is 1 quarter, so that's 1 point. So we're kind of semi-overlapping observations. And then secondly, we have one value of carbon VIX for all the firms. So there should be some kind of clustering.
Yeah, let's check actually how we cluster them. That should be that table. Standard errors are clustered at the firm level and the reporting period, which are not perfectly overlapping, right? They all have, the firms have all their own reporting periods that they report to the CDP survey.
I guess a tangential question is, since you're using quarterly data, why didn't you compute the quarterly VIX?
I mean, these data are annually, right?
Okay, so it's annually.
And later we're going to go to weekly, and you can do the carbon VIX daily if you want to. Yeah, I wish they were reporting this quarterly, but they do it annually with non-overlapping reporting periods.
Sorry, missed that. Thank you.
So on
No
the
problem.
previous slide, a quick question. On the previous slide, you showed like a substantial risk premium on VIX, right? Like, in a
Yes.
graph, right? Substantial risk premium. So my question is, in this regression, so why not using the premium, right? The difference between the realized and the VIX instead of just focusing on VIX?
So there are some papers on
Right?
the
What is the main
premium.
motivation? Yeah.
There are some papers on the premium in carbon options. Here, I only want to measure expected uncertainty, right? So what I really need for these regressions to be valid is that the volatility risk premium in these options is not that time varying. If it jumps around a lot, that might mess up my regressions, but we see no evidence of that. And so that's not a problem. Let me just interpret the first column of this regression real quick. You see that if the carbon VIX goes up by 1 unit, so 1 percentage point, then exposed firms, covered firms, decarbonization investment ratio goes relatively more down by about 0.5 units, so 0.5 euros per ton of emission. And that result is robust to including firm characteristics, and it is robust to including the carbon price as another important explanatory variable. But as I pointed out, there are downsides to this regression, right? I mean, this is what they say is actual spending, but these are voluntary amounts. They are not verified and they're not standardized across firms. They are, as you pointed out, they're low frequency, they're only annually. And maybe most importantly, the point of the decision is not clear. If they tell me they invested in 2015, then I don't know that they made the decision in 2015. So I don't know that's the carbon VIX in 2015 that matters. Maybe it's the carbon VIX in 2013. So I really have a problem of time alignment here. And maybe that is why we do not see the expected positive exposure to the carbon price here. And so to address those potential problems, we move on to the third part of the paper, where we exploit the stock returns of what we call carbon solution providers. Carbon solution providers are firms that help other firms decarbonize their operations. The idea here is that if carbon prices go up, then polluters' incentive to decarbonize should go up, which means expected decarbonization spending goes up, which means that then carbon solution provider stock returns should go up. Or equivalently, if carbon price uncertainty goes up, we would expect polluters' incentive to decarbonize to go down, then expected decarbonization spending to go down, and so carbon solution provider stock returns to go down. The upside of this approach is that we can do it at whatever frequency we have stock returns, right? So our main spec is weekly, we can do it daily, and it captures, or it should capture, changes in expected investment as opposed to realized investment. The downside is that I put stock returns on the left-hand side of my regression now, so I introduce another layer of noise and potential illiquidity. To implement this, I need to do two things. I need to first identify what are carbon solutions, and then I need to identify what are carbon solution providers. And again, I go back to the CDP survey. I told you that these firms give textual descriptions of what exactly they do to decarbonize their operations. And here I give you a stylized example of that. I call it a stylized example because I can't actually show you the data. So we feed all of them into ChatGPT, and then we ask it to make up examples that illustrate the data. So that's what you see here. An answer to the CDP survey, for example, might be, we did something called process efficiency. The activity type is process emission reduction. And the project description is adoption of an innovative carbon capture system at the manufacturing plant to reduce CO2 emissions, etc. Right, I mean, those descriptions do not themselves tell us a product that someone could provide. So we feed all of these descriptions, these about 5,000 descriptions, into GPT, into a large language model, and we ask it to extract just the carbon solutions, just the products and services that could help other firms decarbonize. And for example, in this case, it would come up with carbon capture system, which is something that you can sell, and that can help us find carbon solution providers. And here I just give you a word cloud of the 50 most common types of carbon solutions, just to give you an idea of what we come up with. Renewable energy is a big one. Fleet vehicle replacement, so switching to maybe electric cars, is a big one. Methane leak capture is a big one. Right, and we provide the details in the paper. And now that I know carbon solutions, I can look for carbon solution providers. What we do is, again, we focus on European firms, and we use the firm business description from Orbis. And we feed this business descriptions and the carbon solutions into a large language model. And we ask it for every firm to tell us whether that firm's main business is providing carbon solutions. Since we focus on European firms to make sure they actually do potentially have an exposure, a large exposure to the ETS, we have a sample of about 7,000 firms. And this language model flags about 200 of them as carbon solution providers. Here, I just give you two examples, the Vaga Energy SA, who say they build biomethane projects, and Rockwool, who are responsible for building isolation. I give you some firm characteristics here. These firms span 15 industries across 18 countries. The mean market cap of these firms is 1.5 billion. So if you compare it with a full sample, they're a bit smaller. And if you look at the market to book ratio at 1.3, it's way larger than the sample of for all firms. And that should go with the intuition that these carbon solution providers, they're quite specialized firms, they're quite small firms, and they're growth firms, they're quite highly valued. Now, to get to this stage, to get to my carbon solution providers, we had to take quite some steps, right? So it's important that for robustness, we have other measures. And we do, for example, exploit this recent JF from Sautner and Wilkow and co-authors, who look at the earnings calls of firms across the world. And then as one of their measures that they make available, they tell us whether firms on these earnings calls talk about climate opportunities, about not just the risk, but the opportunity of the climate transition. And we also use that to get indicators for what we call climate opportunity firms. And then finally, we found an ETF that in their perspective, they say they want to profit from Europe's decarbonization efforts. And so we also use those constituents. And to see whether those stock returns of those carbon solution providers are related to carbon markets, we run this regression. We regress weekly stock returns. We do provide robustness checks to show this also works daily, but we prefer weekly because it takes away some of the liquidity concerns. So at the stock level for a specific week, we regress on an indicator, whether this is a carbon solution provider, interacted with the carbon price return over that sample, and then that same indicator interacted with the change in the carbon VIX over that sample. And then again, we have firm characteristics as controls. We have we have stock characteristics. We have stock fixed effects and time fixed effects. And again, we estimate this over two samples, over the high price sample where we expect real effects, and over the low price sample where prices are so low that we don't really expect returns or uncertainty changes to impact anything. And here I show you the result of those regressions. First, just column one, right? You see that, and the right-hand side variables, they are standardized to zero mean and unit variance. So you see that if the carbon price return is higher by 1 standard deviation, then carbon solution provider stock returns are relatively higher by 12.9 basis points during that week. And if carbon VIX changes are higher by 1 standard deviation, then carbon solution provider stock returns are relatively lower by about 16 basis points during that week. And if you look at column 5 over the low price sample, you see that all these coefficients and all these t-stats are just close to 0. So where over the sample where I wouldn't expect a real effect, I actually do not find a relation between stock returns and the carbon market. And over the high price sample, I do find those relations. And I find these across measures. If I use the Sautner et al. Climate opportunity indicators, I find the relatively more positive exposure to carbon prices and the relatively more negative exposure to carbon VIX changes. For the ETF, if I combine these measures, and over the low price sample, for none of these measures, do I see a significant exposure to either prices or uncertainty? If I translate these coefficients, that implies that a 1 percentage point increase in the carbon VIX has about the same effect on the stock returns or on expected decarbonization investments as a €1.12 decline in the carbon price. Yeah, please.
Yes, could I just ask the interpretation of the low carbon price subsample? Are you saying that the prices were not informative, or they didn't care about carbon prices at the time? Because I'm sure they did, right? Because that's what they in business for. Was it just the prices were not informative during that time period? Because to value those firms, you would still kind of thinking about whether carbon is important and valuing them accordingly.
Right. So the interpretation here, if I may go back to the price chart, wherever it was, here, would be that over this early sample, 2013 to 2018, whether carbon prices have a return of plus 5% or minus 5%, this doesn't really impact firms' decisions to decarbonize their investments. And so also it wouldn't impact the value of firms who provide those goods. While if I am here and I see a 5% return, that is like a price change of, I don't know, €5 per ton. So now it's much more likely that a return has a price impact, or that a uncertainty change about the return has an impact on a decision to decarbonize, and thus an impact on the value of carbon solution providers.
Yeah, maybe somewhat related to Valeri's question. I mean, in the equity VIX literature, some very good papers have separated, you know, the upside variance and the downside variance, and sometimes it's labeled good or bad variance, which, you know, here the good or bad would have kind of a different interpretation, I guess. But I imagine that worries about, and that's also maybe related to Fusini's question earlier about the skewness, you know, worries about the price increasing is going to have a very different impact on the return of those firms than worries about the price decreasing. So basically, what's coming from the out-of-the-money puts that are overweight in a VIX metric is probably very different than what's coming from the out-of-the-money calls that are underweight here. So did you ever try working with these things?
Not yet, no. I agree that the tails are very interesting, and there are some things that we checked, like, for example, most volume of these options seems to be in the out-of-the-money call options. Like the puts, out-of-money puts are very expensive, but they don't have all that much volume. So I do think that there are interesting things going on in the tails that we don't understand yet. And it's definitely something that we want to look at.
Upside variance doesn't have to be kind of far out in the tail. So I think it's worth investigating, because you could have stronger effect in your 2018-2022 period. And you could have differential pricing during the early period also of the up and down variance.
Okay. Yeah, we look at it. We kind of wanted to keep this project a bit away from the asymmetry thing and just say, like, okay, we can measure uncertainty, but to keep it clear, because there's so much going on here anyways. But yeah, it's something we haven't exploited sufficiently. It's a good point.
And since I interrupted you, I'll just remind you that we have a hard limit in 4 minutes. So
all right, I'll be done in 3.
Perfect.
All right, let me close this off. Here we just visualize this relationship, this positive relationship between carbon prices, or the carbon price return, and changes in expected decarbonization investments. And here the negative relationship to the carbon VIX. And the way we get there is I basically run the same stock level weekly return regression that I showed you before. It's just that I cut out these interaction terms. So I only regress my control variables so that I get my return residuals for all these firms. And then for the carbon solution providers, I take the average over these return residuals for every week, so that I capture in this measure exactly what I found earlier, to covary more positively with carbon prices and more negatively with the carbon VIX. And I just plot this here in a bin scatter. And we provide these average return residuals of our carbon solution providers on the website, because they really should covary with any variable that impacts expected decarbonization investments in Europe. And so they might also be useful for future research. All right, so let me conclude. We measure carbon price uncertainty. We show it is high. We show it varies substantially over time. And we show it reduces decarbonization investments. And so for policymakers, they really have two levers here. If they want to reduce carbon emissions, they can try to get the price up, or they can try to get carbon price uncertainty down through a price ceiling, maybe through a price floor, or maybe just by providing clearer guidance on what they are going to do. You saw that many of the spikes in the carbon VIX happen around scheduled events. So maybe if they communicate better, if they take a page out of a central banker's playbook, maybe they could have positive impact on this market. All right, we have this website, carbonvix.org, where we provide all the data, like the carbon VIX, the carbon implied volatility measure, carbon prices, our expected decarbonization measures, and all our indicators, who our carbon solution firms are, and what they actually do to help others decarbonize. All right, thanks a lot for listening to the presentation. Thanks a lot for the invitation.
Just a quick question, if you allow it.
Yes,
please.
Of course, please.
Yes, two questions. So first, you mentioned policymakers. So we know that like those in power, sometimes they're against, carbon emission, like, prices or whatever. So they have a certain view of, climate change. And so then my question to you, I know that you don't have a long sample, but is it possible to look at who was in power like during from 2013 to now, and see if you have a more pronounced effect, when more septic politicians are in power or not? And the second question is more about the regression when you have the return on the left-hand side. So that's really interesting. Is it possible also to have on the left-hand side the return on options so that we can see what is going on, like, if your measure has an impact on that?
So, I mean, in the regression that I showed you last, like that one, right? I can't really put the return of options on the left-hand side because I have the carbon VIX on the right-hand side, and so I would be regressing something on itself, basically. On your first point, whether it matters who is in power, I think that's a very interesting question. I doubt that it would show up in our regressions because it is quite noisy, but it might be something that is going on in reality, even though it is hard to capture. And I'm not even sure who is sitting on these committees to make these decisions.
Because that like politicians, you have like firms could lobby, right? Could lobby like politicians so that they have new regulations. Even like before the regulations are put in place, you have different lobbying firms that are working like they get paid by maybe other firms to lobby. You see what I'm saying? So I think that could be interesting to look into that. So I'm not sure if that's a different, it could be a different paper because this is beyond the scope of what you are really doing. So I'm just I'm curious.
Yeah, I feel like there have recently been some great papers on climate lobbying, right? I don't know them well enough, but I think it's something that people are looking at right now.
All right, any last minute questions?
Maybe I'll ask one last question. The solution providers that you guys are talking about, do you find that the prices are more informative? Perhaps that's something interesting to look at in the later sample period, because you still have to value them, right? Before 2015. Perhaps the IVOL went down, right? Because it's still important to value those firms, and perhaps now that these measures that you have more bite, it's easier to measure these value these firms, and they are now better valued.
Yeah, that would be really cool. Yeah, we'll check that, whether the price informativeness of our carbon solution providers increased because now there are just additional things that analysts can